Want a quick edge before the Fed meets? Here's what Kevin Warsh's first FOMC as chair could mean for your portfolio. Markets don't just trade on numbers. They trade on words, cadence, and tone. This debut will show how the Fed plans to talk about rates, inflation, and growth under new leadership. The policy path may not change overnight, but the communication style can reset expectations fast. Stocks, bonds, and ETFs are primed to react because positioning is unusually sensitive to language. Traders will parse each phrase for clues on disinflation's durability and how tolerant the Fed is of slower growth to secure price stability. Here's what to listen for. First, the balance between detail and restraint. A tighter script can reduce knee-jerk swings, while more open-ended commentary can increase rate volatility pricing. Second, the press conference rhythm. Since 2019, the Q&A has been a market mover. If Warsh emphasizes risks of sticky inflation over the progress already made, odds of a higher-for-longer path rise. If he leans toward recent cooling in the data, markets may price a steadier glide path. Third, the framing of the dot plot and projections. Small tweaks in how the range of policy paths is explained can widen or narrow the distribution investors assign to future rates. Fourth, guidance on decision size. If 25 basis point moves remain the default, volatility stays anchored. Clear conditions for deviating from that norm would lift uncertainty around near-term pricing. Finally, balance sheet color matters. Even without new numbers, hints on the pace and mix of runoff can shift term premiums and sector leadership. Warsh's background as a former governor during the global financial crisis suggests a focus on market functioning alongside macro models. That lens can influence how the Fed weighs labor slack, wage trends, and credit conditions when liquidity thins. What can you do now? Tighten your playbook. Map scenarios around a more hawkish tone versus a confidence in disinflation message. Check your duration and rate sensitivity, not just your sector mix. Consider how earnings multiples and credit spreads might respond to signals on labor market slack. Use liquid instruments for tactical tilts and avoid oversized bets before the statement and press conference. After the release, watch how the front end of the curve reprices and how the equity risk premium moves. Those shifts will tell you if tone, not just data, has reset the narrative. Stay nimble, focus on the words, and let price action confirm. Read the full article at finlitica.com.